I think I've met everyone before, but if not, Gordon McArthur, CEO and founder of Beeks Financial.
Fraser, McDonald, CFO.
So I think everyone kind of knows the story, so I wasn't going to do, every single slide. I was going to kind of pick out some of the key ones and go through, the kind of the numbers and the past year rather than the fundamentals of what the business does, if that is okay in the room. Yeah. All right, so I would go to kind of slide 3 then as the first slide. Obviously we have forecasts out in the market and we've now been on market for about 18, 19 months. Our 2-year anniversary is November, so maybe slightly longer than that. So we kind of wanted to put a slide together just showing, what we've done over that kind of year and a half, year and 3/4 period. So with some numbers that are attached to that. So, when we came on market, we delivered revenue of just under 4 million. Full year, the previous year, year end was 7.35. So, we've grown nearly 100% over the 18 months that we've been on market. Our annual committed monthly run rate, which is a key metric for us, it's actually the most for me, it's my most important metric because it shows the overall health of the business. That includes things we've signed in contract that are committed. Some of it might not be delivered yet, but we have a contract that backs it up, right? So we exited the year at 9.1 million. So, nearly doubled that again over the 18-month period that we've been on market. EBITDA has gone from 500,000, we're now 3.5 times that at just under 2.5 million. Customer numbers has gone up 41% over the period. And then the kind of tier 1 space that I've been banging on about since pre-IPO and for the last 18 months, we've managed to win our first 3 customers in that space. And I'm going to talk about these customer wins and the opportunity in that space a lot more as we go through the presentation. So we'll come back to that area. We did our first small acquisition 3 or 4 months ago now. So it was a bolt-on acquisition. It was a retail VPS business. When we started the business as Beeks VPS, it was really us and CNS, based out of San Diego. We grew, they didn't. We've changed the business model slightly. They didn't grow. So it was a small competitive takeout, relatively small transaction for our first transaction on market. Not strategic. It was a commercial play. I think they turn over about $1 million. We paid just over $1 million for them. There's a whole bunch of cost strip out that we're doing, which will finish around December time. And then I think the metrics look about 3 times EBITDA. So commercially, it was a kind of no-brainer deal. We've integrated a very similar business before, so it just felt right to do it. We don't expect it to grow hugely. It's more adds to the bottom line, and took out a small competitor in that retail space. I don't see us doing any more acquisitions in that retail space. They approached us, and the numbers just made it a no-brainer for us. So, but glad to get the first acquisition done. And I think we talked about it interims. We have been to due diligence stage with a couple of entities over the last 18 months and found things in due diligence that kind of ruled the transactions out. So we have been trying, we continue to look, but good to get the first deal done. And if we go to slide 4, so a kind of growing part of the business, and it's linked to the tier 1 stuff, is, if I look back a couple of years ago when we came on market, 90% of our revenue was infrastructure related, so compute resources, whether that be virtual or bare metal. It was us supplying infrastructure as a service. But as we're getting into bigger engagements and as the financial services community embrace the cloud, there is no one cloud that fits all, right? What we're finding is people have a bit of AWS, a bit of Azure, a bit of Google, a bit of us. But there's a growing challenge to connect the systems that sit in this hybrid cloud environment. And the first insurance deal, tier 1 insurance deal that we won last year was really around us providing a hybrid cloud management platform. So an insurance company with 2 on-site data centers who needed to connect, were emptying out their data centers into the cloud, and that's different clouds. We connected their data centers and not very easy areas of the UK to connect to. So we've connected them into our London environment, and then we connect them to both our cloud, to AWS, to Google and Azure, and we manage that connectivity, secure private connectivity for them. So the reason we're talking about it is because it's very much a growing area for us. It's something that we are getting asked about a lot, and we are happy to provide services around it. And I think as we go forward, we will see a bigger split in our business between connectivity and infrastructure. I think it'll get to 50-50 because we are getting involved in a lot more connectivity plays with the larger institutions who have challenges connecting various systems and various different cloud providers. And we're happy to provide that as a managed service. Number 5, I'll just touch on briefly, our network. We opened Singapore and Interaction London 1 for the LME about a year ago now. We did look at Brazil. We talked about Brazil at interims, but we've decided not to go ahead with Brazil for various reasons. It's a difficult country to do business in. The risk reward, when we sat down and looked at it after going through it with Brazilian lawyers and import agents, we've just decided that the risk reward was too skewed. When we set up a data center, there's about 300 grand capex investment to do that. We couldn't source the infrastructure in Brazil, so we had to import it. There's 100% import tax. And the import agents and lawyers that we talked to said, you may get some of your infrastructure through, but don't expect to get all of it through. So we had many conversations like that, and it just kind of became too risky for us. The costs didn't outweighed what we thought we'd get returned. So we've parked Brazil for the moment. We may revisit it, and we are looking at further locations this year, but it's based on customer demand. So we've never just gone into an area with no customer contracts signed beforehand. So there's opportunities for us in Switzerland that may be the next area, and potentially Dubai as well. So we will expand our coverage, is what I'm saying. We don't, at the moment, we are not deploying a new data center at the moment, but we are looking at a few areas. And then I'm not going to steal much of Fraser's thunder. I'm going to let him go through the numbers, and then I'll come back and talk about the kind of tier 1 stuff and how we see the next year shaping up.
Thanks, Gordon. I think slide 6. So at the interim results, we were fairly candid in terms of what that first 6 months looked like. We didn't have a great revenue increase, I think, over the first 6 months. We had not a great start to the year. We had a different sales director back then who didn't really sell an awful lot. We replaced him around 6 months ago with someone who's night and day, and has really delivered on the sales in the second half of the year. So we had a really strong finish. Last quarter was our best ever. Last month was our strongest ever. So in terms of the close out to the year, we finished strongly. So revenue was up 32%. Gordon's touched on it earlier on. The annualised committed monthly recurring revenue exit at 9.1, 32% higher than 6.9. So that was pleasing. Again, growing our customer base as well. So gone from 192 to 220, which is about 15% higher. And I guess that includes as well the 3 tier 1s, which obviously are key to us. Mentioned the acquisition already, which was a small bolt-on. So that was all recurring revenue, and it's about $1 million. So it's about 800k of that annualised committed monthly recurring is included in that. Slide 7. So again, just calling out some of the headline financials. Committed revenue, recognised revenue, both up 32%. Gross profit was up 22%, so going from 3 million to 3.65 in the year. Gross profit margin slightly down on last year, 50%. Gordon mentioned us opening Singapore and London Interaction, 2 new data centres. They are now at break even. They both broke even round about June time, so just at the end of the financial year. So if you look back at our interims, our gross profit margin was 48.5%. So we finished at 50, so that margin's coming back up and coming back round as we anticipated. EBITDA, again, up by about 27% and 34%, so similar margin to last year in terms of EBITDA. Again, similar to where we were before, our model is very scalable. 99% of our revenue is recurring, which is good. So we've got good predictability for the future. Our average monthly client spend now is entry level is 2,200 for the year, as opposed to 800 last year. That does include 3 of the tier ones, which are bigger. If you take them out, it's about 1,500. So it's about doubled, and that's because we've got more locations and we've got more products and more services that we can offer clients when they sign up. And again, looking at our split, so if you exclude the CNS acquisition, which is largely retail, we were sort of 90% institutional, 10% retail. We're sort of back to about 80-20 now with that acquisition. Income statement is kind of more of the same. Graphs all going in the right direction. Turnover, gross profit, and EBITDA showing the key metrics there. And again, looking at some of our margins, so we talked about the gross profit margin. You'll see PBT margin slightly down in last year, but again, because of those, it's been a year of investment and expansion, so that's impacted slightly. If you turn to slide 10, so again, we normally show this slide. So this, and again, a reference to margins. So we do have quite a bit of unused capacity around the world. So that is a sort of map of our data centres and our available capacity across our data centres. So we do have additional capacity as we fill up, depending on the mix of clients. But there is scope, to fill round about £3 million worth of revenue into those racks. Taking on to slide 11. Again, balance sheet shows our net assets, our fixed assets, and our debt. Tangible fixed assets. So we went from 2.2 to 2.4. We actually invested about 1.2 million in new assets, and that's been offset by depreciation of about 900k. The goodwill and intangibles you'll see increased from sort of just under 900 to 2.2. So that includes both the CNS acquisition, which was, as I say, about £1 million of intangible, and we invested quite similar to we did last year, our self-service portal. So again, it's a key strategic project for us. It allows customers to go in and manage their infrastructure, so they can fire up, fire down dedicated servers, virtual private servers. They can monitor their infrastructure with us. So that's been, a good project over the last couple of years that's now live. The next stage, I think Gord might touch on, is network automation for the current year, which we'll cover later. Cash is still healthy, so we've got 2.4 million of cash still since IPO, which should sort of serve our working capital requirements for the next year or so. In terms of our loans, we've repaid quite a bit of historic lease finance that we took on prior to IPO, and we took on a debt facility with our lender to finance the CNS acquisition of about 1 million. So you see our debt's gone from 800 to 1.3, so we've repaid about 500,000 and we've taken out additional 1 million. I think the last financial slide is on cash flow, slide 12. Again, positive. If you look at our operating cash flows, we've gone from 1.5 million last year to 2.3, so over 50% increase in operating cash flow. You can see what we've done. We're on a create cash, reinvest cycle, so we've spent 1.2 million on fixed assets, across our locations. So the split of that is about 80% for new customers to satisfy the demand, and about 20% sort of to existing sort of capital refresh. And again, I've talked about the borrowings and the repayments. So ultimately, we've finished the cash £500,000 down in last year. I think if you looking forward, we'd expect that cash now to start going break even and more cash positive, for similar levels of capex spend, but increased profitability as we move forward next year.
Can we go to slide 15? This is probably where we'll spend most time. So going back to, as I said before, the, why did Beeks IPO? And we had a bit of a working capital requirement, but I think the real reason, the main reason, and it was in this prospectus, in our roadshows, was we were always aspiring to go and capture this tier one market, right? The biggest banks in the world, the biggest investment managers who are spending, tens and hundreds of millions of pounds on infrastructure and connectivity, some doing it themselves, some doing it with other people. As a private entity, it was incredibly difficult for us to do that because, we were bootstrapping the company from a cash point of view. We had various conversations a couple of years ago with some larger entities who, after the meeting, we'd go into the company's house and pull our accounts and see that we had £6,000 in the bank at the end of the year. And, you're asking a big bank to put mission critical infrastructure with a company that's privately held with £6,000 in the bank. It was never a good look, right? So, the whole reason for the IPO was to go and capture this market, and we've been talking about it for 18 months. So, a big breakthrough came at the tail end of last year where we won the insurance company, and I think we talked about it at half year. So it was a good deal for us, but it kind of shows the opportunity and challenges in the space, right? So we signed that deal in November or whatever. In fact, it was probably other than that, September of last year. And we delivered our component, the Beeks component, within about 4 to 6 weeks. Client was happy with it. We've been billing it ever since. But as part of that deal, they had some bespoke connectivity that we had to put in for them. So we've been waiting for 10 months for a third party to deliver a piece of that solution that was effectively a big chunk. We are managing it and putting margin on it. So these bigger, more complex engagements involve third parties, involves longer procurement cycles. So we announced that, and with the best will in the world, we thought that was at the very worst a 3-month go live, and it's taken 9 months, 10 months because of third party delays. So again, it has an impact. Probably maybe we're a little bit naive in how we expected that to roll out. But so that was the first one, and we covered it pretty well in interims. It's now nearly fully billing, and that'll stay there. That's a long-term contract. It'll be there for 8 to 10 years, we think, right? So the two that we announced in July. I'll tackle the first one. It was a proof of concept, right? So it's actually been in live proof of concept production since about May. This is with one of the biggest banks in the world. We're not allowed to name them. We won't be allowed to name them for a long time because we're in proof of concept. We're working with an application providing partner in the space. So the bank in question have an incumbent supplier for the fixed income platform. I can't, again, I'm under NDA, so I can't even go into who that incumbent is, but they have an open mandate that they're going to move from that fixed income provider who provides application, hosting, support, connectivity across the world for the bank, right? They have the bank in question are one of a number of banks that have invested in an alternative application vendor in this space. We are working with the application vendor as a supplier of infrastructure and connectivity. So bank number one, proof of concept, one physical location, one connection to an exchange. That end state of that deployment is 18 locations around the world and 400 connections, right? So while the proof of concept in itself is not a material amount of money for us, we are looking at a rollout that will take 12, 24 months, maybe even longer, for that bank to move off and onto a Beeks global infrastructure where we supply that connectivity and that physical infrastructure with an application partner who's doing the application. That's bank number one. We have conversations ongoing with 3 other large global banks for very similar sized rollout plans that we are looking at over the period. So there is a big opportunity for us in that fixed income space as part of a move to more electronic trading within fixed income. Fixed income is really the last asset class to kind of move into a proper electronic trading arena. It's following the same pattern as every other asset class, equities, futures and forex have done. People are congregating to data centers and then looking for managed service suppliers to supply infrastructure and connectivity for them and manage them. So we were a bit grey in details in the RNS because we had to be, right, and we're under strict NDA, but the size of that opportunity is very large. It's not going to happen overnight. It's going to take a period, but there's a substantial opportunity in that space. So interesting for us, and we're hoping to see more progress with some of the other institutions and the further rollout of institution number one in the first half of the year. So we are tracking that. So that's kind of given some context, as much context as I can at the moment on that first tier one in the RNS from July. The second one of the largest asset investment management companies in the world, very big US entity with a very big presence in London. because of the congregation of fixed income providers in and around where we are, we can now connect 90% of the venues via a wide area network and our point-to-point connectivity within the data centre. There's 14 venues in the UK. That will take 3 to 6 months, maybe even a bit longer. Again, we have to realise what's happening in the back end here. These are institutions that are sometimes auctioning government bonds. If the systems fail and the government bonds don't complete, then there's some questions to be answered at a government level. So it's slow moving, so there's 14 connections for the UK side of that business. There is the US side of the business starting to look at a similar project where they're looking at over 200 connections to various venues, predominantly in and around the US. And we reckon we can get to about 60 to 65% of them within our ecosystem. So the reason I'm talking about these three is because I think, while some of the numbers and the phase one of these projects are big for Beeks, I think we have a land and expand opportunity in all of these three. We have more coming down the pipeline. And a big part of the forecast for next year is kind of both landing and expanding on the three we've done and signing some more in the tier one space. We need to be looking at a few of these larger enterprises to move the needle on our business, right? We're not going to get to 20, 30, 40 million, whatever you want to put up there, by just solely doing mid-market institutions that do $2,000 a month, right? It would take too long, and we would need to get a big part of the market share. So that's the reason we've always been focused on growing up into this tier one market, is because of the size of the prize there. We are not walking away from the mid-market, so we've just increased our sales team up in Glasgow to continue the small deal engine that sits up there, continue to deal with the mid-market. We won't, it's absolutely core to our service as well, and we won't walk away with it. But where we move the dial longer term is capturing the tier one market. And getting the first one was one of the biggest things that we've done, because again, we've had conversations before with a big institution and they come back to, who do you do this for? Tell me who's, and if you say no one, then the conversation ends very quickly. Now we've got customers who will take a call, while they won't let us put them in the public domain yet. We hope soon they are taking reference calls for us, which is a big deal. If we go to slide 17. So what we're looking at for the next year, areas of investment and what have you. So what we're realising is, as we go through multiple iterations of onboarding with bigger institutions, there's ways we can speed it up, right? And we're investing a lot of time and effort in that. So when you get a procurement or an RFP or whatever vendor onboarding, the first two questions are you ISO 27001 certified? Tick. You kind of move on to the next section. No, answer the 300 questions below. And at the moment, we are having to say no, because we are going through ISO certification, but we don't have it. And it's the same with SOX, right? So SOX is just the next level above and more US-centric. So our CEO is tasked with getting us through an ISO, being ISO accredited by the end of next year, and being, starting that SOX process, which is a little bit more involved. So we're spending a lot of time, money and effort, third-party help, internal resource, to be able to put the tick in these two boxes. That speeds up a lot of the admin that we're dealing with at the moment. So we're going to spend some money and time there. The big project that we've got for the next year, internally improving our systems, is network automation. So we've got a fully automated infrastructure deployment portal where you can build a dedicated server yourself, a virtual machine yourself. We're about to launch automated backup as a service, which we've been working on for a year. It's taken a long time. So people are going to be able to send images and data to an off-site data center location for compliance purposes. You can store it, you can re-image your server. That's been ongoing. So, as an automated offering, the infrastructure component is more or less done. The big piece is then the network automation that sits on top of that. So we are still doing a lot of manual network tasks, adding cross connects, adding VLANs, IP addressing, VPNs. So We're going to spend some money over the next 12 or 18 months automating that network and putting out what's called a kind of SD-WAN, so a bit of a IT buzzword, but it's a kind of automated networks layer that reduces the need for us to keep employing very expensive network engineers and adding on people, and giving customers the ability to do stuff themselves via the portal. So that's a big project. That's a 12 or 18 month project to get it, because getting it wrong and automating something that goes and kills the network is, again, not great. In terms of service expansion, backup as a service, so just touched on it. So we've been asked for this for the last 2 years for clients. So we've always had the ability to back up VMs, because there's a bunch of tools out there that just do it. But the dedicated bare metal servers, which is what the majority of our institutional clients use, we've never backed up, right? So we tell them we don't back this up. It's up to you. And they keep saying, well, can you not come up with something? And we've had instances where production trading server had just blown up for whatever reason. The motherboard's gone, the CPU's gone. And we always tell clients to buy backup servers. Sometimes they do, sometimes they don't. And brokerages have lost a bunch of data, whatever. So now via the portal, they're going to have a backup now. They can pick the retention policy. We pay for how much storage space they will take. So that is in beta release at the moment. We hope that will go live in about a month's time. So that's just increasing the amount of wallet share from existing clients. We know it's going to sell relatively quickly. It's not going to put 100 grand a month on, but it will gradually increment a few grand a month. So, it's been a year-long process. It shouldn't have been taking as long, but it's been a bit of a big software build-out. New geographies are discussed, depending on client demand, and then, looking at customer stuff. Further, there's conversations with other tier ones that have been ongoing or starting. Again, at the most senior level in the organisation, we're heavily engaged. Head of sales, myself, our COO, looking at these tier one opportunities and continue to increase the mid-tier. We will not, the retail customer base will not expand for any great note. It's not a focus. I know it sounds silly that we made our first acquisition in that space, and we're not saying it's not a focus. It was a commercially led deal, but we don't expect the retail base to grow, and we're not focused on it. Summary and outlook, I think first half, interims hands up, we didn't have a great half. Some sales moved out. We replaced a commercial director in December. Alan, who's come in, has changed the pipeline dramatically. He's got credibility. And just in terms of the team as well, just want to touch briefly on that. So we've taken 3 or 4 really senior people over the last few months. So our team is stronger than ever. So we've taken a head of pre-sales, who worked at Equinix, our big data center partner, and he managed all the deployments and designed all the deployments for the tier 1 banks in London. So he now heads up our pre-sales and delivery teams. Alan, we took from Equinix, again, was selling into tier 1 banks in London. So the team is stronger than ever. We had our best half year, we had our best quarter, we had our best month ever into the end of the year. I think in June we signed about 60 grand a month of recurring revenue from new clients. Our previous best was 30. I think, so Q4 showed real promise. The doldrum months of July and August, where usually it's just nothing, so it's been a decent start to the year. It was certainly better than last year. So that momentum has followed into the new year. So we've got land and expand opportunities with the 3 clients we've already talked about in the tier 1 space, a bunch of other tier 1s that we are in discussions with. We're looking at a big year in terms of forecasts. We understand that. It's achievable, it's challenging, it's achievable. And, our internal targets for a sales team are way beyond what that the kind of public-facing broker notes are. So, we go into the year in a better position than I think we've ever been. At half year, hands up, it was a very different story. So the last 6 months have been great, and the team had a great closeout to the year. Everyone worked incredibly hard, and we've had our best period ever. So, we go into the next year, with a big challenge in terms of, we need to see a lot of growth, but in a better position than we've ever been, I think. So I look at the year with confidence rather than anything else. If anyone's got any questions.
How are you defending your niche? You're quite small, but you're rolling around in the sand with elephants. When you're suggesting insurance companies that you can take away, up with that layer of changing their servers to Azure, Amazon, whatever it is, there are lots of people trying to get into this thing. What's making it your area that is defensible? Because there would seem to be big people who want to move down into your space and others who want to move up into it and so on.
So I think, there's two parts to that, right? So in our low latency cloud offering, right, where we are connecting people to exchanges and venues and things like that, and we've discussed this before, but you need to be in the same data center as the exchanges and the venues, right? The big guys on the whole are not, AWS and Google run their own data centers, right? There's connectivity appearing, but if you're not, for instance, if you're not in the CME's data center, you can't connect directly to the CME matching engine, right? So that rules out some of the big guys from competing in our core, right? AWS are not going into the CME's data center, or Google or not, they just won't, right? It's the CME's data center. Same with SGX and all these other places. So we defend our position in that space by connecting directly to all the exchanges and venues, secure private connectivity within the data center. In the hybrid cloud space, we're financial services focused. We will see some competition in that space. The big guys don't connect to each other. They're all fighting a horrible battle with each other, so there's no interest in connecting each other. So there are organizations that's playing in the space. Yeah, so it's competitive. I think going into the connectivity, the networking and connectivity as a service, again, this is, if I to look at the investment banks and the fixed income stuff, the point is, what happens when it breaks, right? So there's all this market data flowing between these venues and exchanges, right? So a common call to our NOC is, we have a gap in our market data, right? So we are sending a packet and it's, or we're sending a price, but the venue's not receiving it 3 quotes later. Can you, help, what's going on in the network? So that is deep technical market data and networking experience. A generic hoster, you phone them up and ask that question and they have no idea what you're talking about. So the ability to troubleshoot financial services problems, it's the same, it's vice versa. I mean, we don't host email systems or CRMs. If someone phoned us up and said they've got a problem with their email system, our engineers would, you have no idea. Go and look at it yourself. So it's having the skills and the knowledge to put that networking together, low latency networking, secure network, and then being able to support it. There's not that many. We've got three, and we've 3 big competitors, historical competitors in our space. 2 in London, 1 in New York. We don't really see any new entrants into the space. We're the kind of upcoming, biting at the big guys' heels at the moment. They've historically looked after that tier 1 space, and we are gradually causing them some problems in there. But I'm not seeing any new entrants in. That answered the question.
Okay, thank you.
And what are they doing to stop you encroaching on their space?
Some of them are talking to us about doing stuff with us and allowing them to sell what we do. So there's some cooperation goes on as well. So, but a lot of them are still, it's just, there's organisations in London that have been dealing with the big banks for many years, and once you've got them, it's they don't move, right? So they've got whoever it be. I'm not going to go into names, but they're taking 20, 30 million a year from X, Y, and Z bank. It's more a case of let's go and take another 20 million from another part of that bank. That's where we see them. So yeah, we've not seen anyone look at delivering this as a true cloud service, and I've talked about this before. And where you can manage it via a web portal, it's 30-day commitments. Our competitors are still old school, tie you in for 12, 24, 36 months, which is fine for a big bank deployment, but In the mid-market, that doesn't work. But we're not seeing the kind of traditional big three going down and kind of doing a kind of cloud service. It's not to say they won't, but they're not done it yet.
But the tier one customers that you want could they have the money to do it, and they have technical resources that are extremely deep, right?
The tier one, what do you mean, the actual clients themselves?
Yes.
They are more and more outsourcing all of this. They are not interested. It's becoming widely accepted that it's faster, cheaper, better supported if you get third parties to do it for you. More and more of the big guys are saying, why are we spending 50 million in capex and paying, engineers hundreds of thousands of pounds to go into a data center once a week? It's going the opposite way. They are more and more outsourcing it.
Your profits at the moment are really only growing, if I may say so. I don't mean this critically, because you've doubled your capitalization development costs from 400,000 to 800,000. And I assume by the very nature of your business, we can expect to go on seeing this. Private investors, at least certainly this private investor, likes to see these things just expensed off. And I do understand if you say, no, we have to do this because we're a small company and it's valuable to us. But is this going to be an ongoing feature, do you think?
I think in terms of the first point, so, according to accounting standard, we have to capitalise it. It's not a choice. That spend represents, Gordon talked about earlier, the self-service portal. So that is mainly our in-house development team, specialist team of developers who are creating that bespoke software to enable our customers to manage their own infrastructure. So if the spend on it this year was similar to last year. It was about 400k on each year, but we have to impairment test that every year. We have to demonstrate that there is a future economic benefit, of that project or that program, and it is both revenue generating and cost avoidance for us, because what it does is, as Gordon mentioned earlier, we do not have to, increase our network support team, at the same level, because the customers can do that themselves, and it stops us having to, bring in additional engineers.
Therefore, I think my question is really, can we expect this to continue to grow?
Yeah, I think the next stage is the automation of the network, which is probably a bigger project. Yep, it will be. Yeah. But again, it's being amortised. It'll be a, again, similar sort of 5-year economic use.
But it can't be capitalised until it's actually a usable product, right?
Yeah, so what's been amortised, there's 2 stages so far. It's been amortised, so we put the dedicated servers live and the virtual private servers live. The retail part, which I think we're just about to go live in the next month, and that'll be it, that fully amortised from that stage. And then the next stage is the automation of the network.
So capex generally over the next couple of years can consider to be, or for as long as you can grow, it's going to be significant, right?
Yeah, and again, capex has been about 100k per month roughly the last couple of years. If we do take on these bigger tier one, or depending on the mix of how that looks, then obviously that would increase.
With the 9-month build-up to get sort of revenue coming in, presumably the capex is going to arrive before the revenue does.
Again, it depends, because again, depending on the mix. So I think Gordon talked about if it's connectivity. If it's a connectivity play, then it's mainly OPEX. It's not a big capital expenditure. If it's putting servers in, data centres across the world, then it would be more capital intensive.
I mean, a connected point is that although you're making profits, your free cash flow is marginally negative. Should you be having a dividend policy at this stage, given the fact that you're anticipating further growth and further spending on CapEx and intangibles?
Yeah, I mean, I think so. If you look at our free cash flow was £500,000, I think.
Depends how you define the finance lease repayments, and since the change in IFRS 16, then arguably they should now be deducted off the free cash flow. So
IFRS 16, that's an interesting one in terms of the hassle that's caused over year end. But IFRS 16 will have an impact on us next year in terms of additional assets and liabilities coming onto our balance sheet. So our EBITDA will go up around about 400k this year, just purely on IFRS 16.
But yeah, I mean, on the dividend, I think we said at IPO, we're never going to pay a high yield dividend, but we're still cash positive. I think if you take away, the finance repayments will be gone by the end of next year. We expect to be generating cash, so we'll continue to return a modest dividend to shareholders.
So the finance lease is for...
So finance leases will be done by...
Yeah.
So the finance leases, we've not taken any finance leases since IPO. We've got about £500,000 of finance leases left. You'll be gone by the end of this financial
So you've
year.
not adopted IFRS 16 in these numbers?
IFRS 16 from this year. We'll adopt it, yeah.
Can I ask whether the margins on connectivity and infrastructure are the same you're expecting going forward, or would you expect them to be much less on connectivity if you're just reselling a connection in effect?
No, we kind of go with a 50% margin on connectivity, because it's not just putting it in. Then people want that monitored, managed 24/7, expensive network engineers sitting watching it, fixing it. So, we apply a healthy margin if you want that service. If you just want us to put in a cross connect or a connectivity and never look at it and don't tell you if it's down or don't fix it if it's down, then the margin's lower. But nobody wants that to happen. So, we'll maintain that. We will try and maintain that 50% margin on connectivity as well as the infrastructure.
I just think that might be hard in terms of if you have lots of connectivity, you still just need the one person to manage it. If you've got an automated system or whatever, or some system to manage it, actually adding more connectivity, you can't keep adding 50% on each connection. Or?
We can. I mean, that's the nature of the deals. It's if you look at Equinix, some of the data center providers who charge, so an in-house cross connect or an in-house connection, Equinix charge $500 a month for it, right, per connection, and all they're doing is giving you a $10 piece of fibre between, point to point, and they don't care if you want 500, it's 500 a month for each $10 piece of fibre. So it's the same business model for us.
Can I just go back to CapEx? What do you expect CapEx to, as you're rolling out to tier 1 clients, it's going to go up from 100 grand a month. What can we expect?
It very much depends on the scale of the deployment, so yes, you're right, it will go up in terms of working out how much that will be. I mean, it'll be a nice problem to have, is my honest answer, because we will fund it, whatever way we want to fund it. So it very much depends on the flavour of the deal. As I said, the connectivity is more OPEX, infrastructure is CapEx, if that we will scale to support that, however.
Yeah, and there's £2.5 million of cash in the bank. I think we've talked about this before. On connectivity, it's an OPEX model. If you've got to go and buy, 1,000 servers, whatever it is, our CapEx payback on that investment is 6 months. So whatever deal we strike, we're looking to get that cash back in 6 months. None of the support costs or anything, or implementation costs, but in a pure hard CapEx return, it's 6 months.
So can we expect it to double?
If it does, Tamsin, we're in a good place. If CapEx doubling is not, if it does, I'm happy, because it means we've signed lots of big deals that are out there earning. So it really will depend on the deal we sign. Is it connectivity, is it infrastructure? How quickly do we need to roll it out? Have we got our own capacity? All of these things. Some of the bigger guys are happy to pay 5-6 months in advance as well. You can charge big implementation fees. So it's an impossible question for us to answer. But if it's double, we'll be happy. All right.
Thank you both very much indeed.
Thank you.
Yes.